The government has already set aside up to $628 this year for every Canadian senior who qualifies, and most of them will never collect it because nobody told them to file a specific line on their tax return. That is not an accident. These programs exist, they are funded, and they pay out only to the people who know to ask. The people who do not ask simply do not get the money. It goes back into general revenue. The government keeps it. This is not one benefit. There are 12 of them. 12 things that Canadian seniors at 65 either stop paying entirely or start collecting. And the list is sitting inside the tax code, inside provincial health regulations, and inside CRA forms that most preparers never pull out unless you specifically ask for them. By the time this video is done, you will have the complete list. Every dollar amount, every form name, every form name. I am James Caldwell, and I have spent 11 years going through Canadian tax returns and retirement files. The pattern I see over and over is seniors leaving money on the table that the government never volunteers to give back. In this video, I am going to walk you through all 12 items, the federal ones, the provincial ones, the ones on your tax return, and the ones that require a phone call. Most of them stack. You can claim several of them at the same time. And number 10 on this list is one I guarantee most people watching have never heard of. I will get to it at the 9-minute mark, and it applies even if you are still working. I want to explain this the same way I would explain it to a family member sitting across from me. No jargon, no forms to decode, just the actual numbers and exactly what they mean for your situation. Before we get into it, if this kind of detail is useful to you, subscribe to this channel. Now let us get into it. Let's start with something that came into effect recently and is still largely unknown. Number 1. The Canada Groceries and Essentials Benefit. This is a refundable tax credit that came in quietly and has not been widely publicized. The maximum is $628 per year. It is paid out automatically, but only if you file your taxes and your income falls under the threshold. That is the catch. The CRA does not send a letter telling you that you qualify. They do not call. If you do not file, nothing happens. The money does not come to you. Frank found out about this one from his daughter. He is 67, retired from manufacturing in Mississauga, and collects CPP of $1,100 a month. He filed his taxes every year, but until his daughter looked at his return with him, nobody had pointed to this benefit specifically. It showed up as a line item he had never noticed. His wife Helen, 65, and still doing part-time bookkeeping, also qualified in her own right. Combined, that is over $1,200 a year that they had been leaving on the table without knowing it. The form is part of your T1 return. The key is simply filing, accurately, on time, every year. If your income is below the threshold, the credit calculates automatically. If you use a free tax clinic, which I will come back to at the end of this video, they will catch this for you. Number 2. Provincial Seniors Drug Plans. This one costs most seniors hundreds of dollars a year in premiums and co-pays that they do not need to pay, because the provincial programs cap those costs once you register. In Ontario, the Ontario Drug Benefit Program sets a maximum annual co-pay of $100 once you reach 65. Without the ODB, a senior picking up 3 or 4 prescriptions a month could easily pay over $1,000 a year in drug costs. Ontario does not enroll you automatically. You need to apply, and your pharmacist can help with the paperwork. In British Columbia, BC Fair Pharmacare sets your annual deductible based on your net income. Once you hit that deductible, the province covers 80% of eligible drug costs, and once a second threshold is reached, it covers 100%. Seniors with lower incomes have their deductibles reduced significantly. Again, not automatic. Registration is through Health Insurance BC. In Alberta, the Seniors Drug Benefit covers most prescription drugs for Albertans 65 and older, with a flat copay of $5 per prescription, up to a maximum of $25 per month. Income tested for some add-ons, but the base program is broad. Helen had been picking up her blood pressure medication at full price for 6 months after turning 65 before anyone mentioned ODB to her. When she registered, her annual drug costs dropped by over $400. Number 3. Property tax grants. This is one of the most consistently missed benefits for seniors who own their homes, and the amounts are real. In Ontario, the Ontario Senior Homeowners Property Tax Grant provides up to $500 per year. It is claimed on your provincial tax return, Schedule ON 479, and it is income tested, so it phases out at higher incomes. If Frank and Helen own their Mississauga home, which they do, and their combined net income falls under the threshold, they can claim this grant every single year. It does not expire. It renews annually as long as they file. In British Columbia, the Property Tax Deferment Program allows eligible seniors to defer property taxes until the home is sold, at a low interest rate set by the province. For those who want to reduce out-of-pocket costs right now rather than defer, the BC Seniors Home Renovation Tax Credit and the property tax exemption in certain municipalities can reduce the annual bill by up to $845 depending on location and eligibility. These grants are claimed at tax time or through your municipality. They are not sent to you unprompted. One more thing on property taxes that is worth knowing. Several Ontario municipalities also offer their own senior property tax rebate programs on top of the provincial grant. The City of Toronto, for example, has a low-income senior property tax rebate that runs separately from the provincial OSHPTG. If you live in a major city, contact your municipal tax office directly and ask whether a senior rebate exists at the municipal level. Many seniors do not know to ask the city separately from the province, and both can be claimed in the same year. Number 4, the Home Accessibility Tax Credit. This is a federal credit. It covers renovations to your home that make it safer or more accessible. Grab bars, wheelchair ramps, walk-in tubs, wider doorways. The government allows you to claim 15% of eligible expenses up to $20,000, which means a maximum federal credit of $3,000 in a single tax year. The work has to be done by a qualified contractor and you need the receipts. But for any senior who has done or is planning accessibility work on their home, this credit is sitting there on Schedule 12 of the T1 return waiting to be claimed. Frank had a handrail installed on the back steps last year and a grab bar in the bathroom. Total cost was around $1,800. He had no idea those expenses qualified for a federal tax credit. That is $270 he left behind when his return was filed without it. The CRA lists the qualifying expenditures on their website. If you have done any work to your home to make it safer to live in, pull those receipts and check them against the list before you file. Number 5, the age amount plus the pension income amount. These are two separate federal tax credits that are often missed or claimed incorrectly, and together they are worth over $1,600 a year off your federal tax bill. The age amount is a non-refundable federal credit available to anyone 65 and over, provided their net income is below the federal threshold. The base amount is currently just over $8,000, and 15% of that is over $1,200 in federal tax savings. If your income is below the threshold, you claim the full amount. If you are above it, it phases out, but for many seniors it is still partially available. The pension income amount is a separate credit. Up to $2,000 of eligible pension income can be used to reduce federal tax, which at 15% is another $300. Eligible income includes RRIF withdrawals, RPP payments, annuity income, and CPP. It does not include OAS on its own, but combined with other income sources, most retired seniors qualify for at least part of this credit. These are claimed on Schedule 1 of your T1 return. Neither requires any separate application. They are there every year. Whether you get them depends on whether your preparer remembers to check. Number 6. Pension income splitting. This is the one that has the most impact for couples where one spouse earns significantly more pension income than the other, and it is the one most preparers do not bring up unless asked directly. The rule is this: up to 50% of eligible pension income can be transferred from the higher income spouse to the lower income spouse on the joint tax return. The form is T132. It is filed with your T1 annually. When done correctly, it moves income from a higher tax bracket to a lower one and reduces the combined household tax bill. For Frank and Helen, this is significant. Frank's CPP, RRIF withdrawals, and former employer pension income put him in a higher bracket. Helen's income from part-time bookkeeping is lower. Splitting up to 50% of Frank's eligible pension income to Helen's return could reduce their combined federal and provincial tax by several hundred to over $1,000 a year depending on the spread between their incomes. What most people miss, this is not done automatically. It must be elected each year. If your previous preparer did not file the T2032, you did not get the split. You may be able to request an adjustment for previous years through the T1 ADJ process if it was missed. There is also a secondary benefit to pension splitting that most people overlook entirely. When income is shifted to the lower earning spouse, it can preserve or expand that spouse's eligibility for income-tested credits, including the GIS, the age amount, and even the property tax grant. So the split does not just reduce the higher earner's tax, it can simultaneously unlock additional benefits for the lower earner that would have been clawed back or phased out at the higher combined income level. This is why pension splitting, when done correctly, has a multiplier effect on the household. One form, multiple payoffs. Number 7. The Canadian Dental Care Plan. The Canadian Dental Care Plan launched in 2024 and covers basic dental services, exams, cleanings, fillings, extractions, dentures, for Canadians whose household net income is under $90,000 per year. For those under $70,000, coverage is 100% of eligible services. Between $70,000 and $90,000, there is a copayment of 40%. Most seniors, 65 and older, who do not have employer or retiree dental coverage and whose household income falls under those thresholds qualify. Enrollment is through the federal government portal, and your dentist needs to be registered with the plan. Helen had been putting off a cleaning and a cracked filling for 8 months because she did not have dental coverage and did not want to pay out of pocket. When Frank looked into the Canadian Dental Care Plan, she was eligible for full coverage. The 2 appointments together would have cost her over $500 privately. If any of these apply to you, leave a comment below with the number, just the number, and I will know you watched the full list. Number 8. Provincial health extras that start at 65. This one is less talked about because it is not a single benefit. It is a collection of things that quietly become free when you turn 65 and are delivered through your provincial health card, not through your tax return. In Ontario, eye exams become fully covered by OHIP at 65, one complete eye exam every 12 months. Before 65, adults pay out of pocket or through private insurance. After 65, you present your health card. Most Ontario seniors do not know this applies the moment they turn 65, not at some later enrollment date. It is automatic. Ontario also covers certain vaccines, audiology assessments, and limited foot care services under OHIP for seniors. The specifics depend on your physician's referral and the service, but the point is that these services exist and are covered. In other provinces, equivalent programs vary. In BC, the MSP covers a broader range of preventative services for seniors. In Quebec, certain hearing services and vision aids are covered under the provincial plan at 65. The starting point is always your provincial health card office or your family physician. Ask specifically what becomes covered when you turn 65. Number 9. Senior transit discounts. This seems small compared to the others on this list, but for seniors who rely on transit, it adds up fast, and the critical point is that it is almost never applied automatically. In Toronto, TTC Seniors Presto fare is 30% below the adult fare. In Ottawa, OC Transpo seniors pay a reduced monthly pass rate. In Vancouver, TransLink offers a senior discount through a separate Compass card registration. In Calgary, Calgary Transit seniors over 65 pay a reduced monthly rate. Not one of these discounts is applied the moment you turn 65. Every single one requires you to go to the transit office or portal and register your age. Some require documentation, some require a new card. None of them will appear on your regular card without the request. Frank drives and has never needed this. But Helen mentioned to me that her sister in Toronto had been paying full adult transit fare for 2 years after her 65th birthday because she did not know to ask. That is a $200 per year mistake for 2 years. $400 left on the table because no one put up a sign. Register, show ID, ask for the senior card. That is all it takes. Number 10. Stopping CPP contributions if you are still working. This is the one I mentioned at the start, and I want to say clearly, this is the benefit that surprises people most. If you are 65 or older, already receiving your CPP retirement pension, and you are still working, you are still being deducted CPP contributions from your paycheck. Both you and your employer are paying into CPP every single pay period. That is happening right now if this describes you. And those contributions are mandatory. Unless you opt out, the form is CPT 30. It is filed with your employer. Once you submit it, your employer stops deducting CPP from your paycheck, and you stop paying the employee portion, which can be as high as $3,867 per year in 2025. There is a trade-off. Those contributions you make while working past 65 do generate a small additional CPP benefit called the post-retirement benefit. If you opt out, you stop accumulating that. Whether opting out makes sense depends on your income, your health, and how long you expect to work. But the key fact is this: most people working past 65 who are already on CPP do not know they have the option. They assume CPP deductions are mandatory for everyone. They are not mandatory for you after 65 if you are already receiving your pension. The CRA will never proactively tell you this. Frank is retired, so this does not apply to him directly. But his nephew, 66, still working part-time and collecting CPP, had no idea this option existed. When he looked at his paycheck, he was paying over $250 a month into CPP on top of everything else. Filing CPT 30 stopped that immediately. The decision of whether to opt out is not automatic. It depends on how many more years you plan to work. Each year of continued contributions after 65 does generate a small post-retirement benefit that adds to your monthly CPP for life. But the math only works in your favor if you live long enough to recoup the contributions through that extra monthly increment. For someone already in their late 60s working part-time in a lower-wage role, the break-even point often extends well past 80. A registered tax professional can run this calculation for your specific situation. The point is that you have a choice, and right now, most people in this situation do not know the choice exists. And the last item on this list is the one that unlocks almost everything else. I will show you exactly what it is in 2 minutes. Number 11, GIS and Ontario gains. The Guaranteed Income Supplement is the federal top-up for OAS recipients whose income is very low. The maximum GIS payment as of 2025 is over $1,086 per month on top of OAS. That is a combined monthly payment approaching $1,800 for a single senior with no other income. GIS is income tested and reassessed every year based on your prior year tax return, which means, again, filing taxes is not optional. If you do not file, the CRA cannot calculate your GIS entitlement, and your payments can stop or never start. In Ontario, there is an additional provincial top-up called the Guaranteed Annual Income System, or GAINS. GAINS adds up to $166 per month on top of GIS for eligible Ontario seniors. It is the province's recognition that federal GIS alone is not enough for the lowest income seniors in the province. Like GIS, it requires a filed tax return to calculate. Helen's aunt, 81, had never applied for GIS. She had been receiving OAS, but assumed GIS was something you had to apply for separately in a complicated way. It is not. The CRA automatically assesses GIS eligibility from your tax return and sends you a letter if you qualify. But if the return is not filed, the assessment never happens. Her aunt filed 3 years of back returns with help from a free clinic and received a GIS retroactive payment covering the months she had missed. Number 12, the free tax clinic through CVITP and 211.ca. This is the one that unlocks almost everything else on this list in a single appointment. The Community Volunteer Income Tax Program, or CVITP, is a federal program where trained volunteers prepare tax returns for free for seniors and low to moderate income Canadians. These clinics are authorized by the CRA, the volunteers are trained by the CRA, and the returns are filed electronically through CRA systems. What most people do not know is that these clinics do not just file your taxes. A good CVITP volunteer will review your return for the age amount, the pension income amount, the home accessibility tax credit, the groceries and essentials benefit, your GIS eligibility, your gains eligibility, and any provincial credits you may have missed. In one appointment, 6 to 8 of the items on this list can be caught and claimed or applied for. To find a clinic near you, go to 211.caa or search CRA CVITP on canada.caa. Clinics run primarily February through April, with some year-round locations. Some operate by appointment, some by drop-in. Bring your T4s, your RRIF or pension statements, your property tax bill, your rent receipts if applicable, and any medical or accessibility renovation receipts you have. Frank and Helen used a CVITP clinic last year for the first time after their regular preparer retired. The volunteer caught the age amount, the pension income amount, the groceries and essentials benefit, and triggered their GIS review, all in one session. They left with a refund they were not expecting and a GIS confirmation letter in the mail 3 weeks later. Before I give you the checklist, I want to stop on one question I know some of you are already asking. If all of this is real, why has nobody told you? Why are you hearing it from a YouTube channel and not from Service Canada or CRA directly? The honest answer is not complicated. CRA is designed to collect. Service Canada is designed to process. Neither one is designed to reach out and make sure you claimed everything you were entitled to. That is not what they do. The system is set up so that the money goes to the people who know to ask for it. If you do not ask, it does not come. That is not a conspiracy. It is just how a passive system works. That is why this channel exists. Now here is exactly what to do. That is the full list. Here is the checklist. Number 1, the Canada Groceries and Essentials benefit. File your taxes and it calculates automatically. Number 2, your Provincial Seniors Drug Plan. Call your pharmacist or go to your Provincial Health Authority website and register. Number 3, your Property Tax Grant. Claim it on your provincial tax return or contact your municipality. Number 4, the Home Accessibility Tax Credit. Pull your receipts and claim Schedule 12 on your T1. Number 5, the age amount plus the pension income amount. Schedule 1, T1 return every year. Number 6, pension income splitting. T132, file it with your annual return if you are a couple with different income levels. Number 7, the Canadian Dental Care Plan. Enroll through the federal portal if your household income is under $90,000. Number 8, Provincial Health Extras. Call your provincial health card office and ask what is automatic at 65. Number 9, Senior Transit Discount. Go to your local transit office, bring ID, get the senior card. Number 10, stopping CPP deductions if working past 65 and already on CPP. File CPT 30 with your employer. Number 11, GIS and Ontario gains. File your taxes every year, without exception. Number 12, free tax clinic. Go to 211.ca or search CRA CVITP. Book an appointment before April. One more thing before you go. If you know a Canadian senior, a parent, a neighbor, someone at your church, send them this video. Do not just think about it. Send it right now. I promise you there is a real chance they are missing at least one thing on this list and have no idea. Forwarding a 15-minute video could be worth thousands of dollars to someone you care about. If you want all 12 of these in one place, the form names, the program names, and the phone numbers, I have put together a free PDF checklist. The link is in the description below. No sign-up required. Download it and take it to your next tax appointment or your next CVITP clinic. The next video covers what happens to your OAS and GIS if you leave Canada for more than 6 months. The rule is stricter than most people expect, and the consequences of getting it wrong can take years to recover from. This video contains general information only. It is not personal tax advice, and it is not personal financial advice. Every situation is different. Please consult a registered Canadian tax professional before making any decisions about your retirement finances or tax return. I am James Caldwell. The rules are written in your favor. Most people just never find out where to look. I will see you in the next one. End of report.